Nike. With over 1,000 stores worldwide, and with some of the most recognizable athletes worldwide on their payroll, it's hard to believe that the stock price has fallen over 30% this year. However, to understand the full picture with Nike, we need to go all the way back to 2021. In June of 2021, Nike reported their earnings, and they blew analyst expectations out of the water, reporting EPS of 93 cents versus an expected 51 cents. And they beat on the top line as well, reporting $12.34 billion versus an expected $11.01 billion. However, what was most impressive to investors was Nike's direct-to-consumer business, which had grown 41% year over year and risen 147% since 2019. And this new strategy from Nike to go direct to consumers showed the potential of being very profitable, as they would be cutting out a lot of the middlemen retailers that ate into their profit margins. And this strategy from Nike was very intentional, as the CEO John Donahoe had this to say after their 2021 earnings report. Fiscal year 21 was a pivotal year for Nike as we brought our consumer direct acceleration strategy to life across the marketplace. These positive results and this shift in Nike's strategy led to the stock price moving up almost 35% in the course of the next month. However, in Nike's very next earnings report in September of 2021, the cracks started to form, as Nike Direct was now growing by only 28%, down from the 41% growth they had seen the quarter before. On top of that, Nike was being affected by factors out of their control. Some of their factories in Vietnam were experiencing labor shortages as well as prolonged production shutdowns associated with the pandemic. And this ultimately led Nike to lower their revenue expectations for the full fiscal year, from low double-digit growth to mid-single-digit growth. And despite all of that news, investors continued to buy up the stock, sending it up over 20% in the course of the next month. By the end of 2021, investors were willing to pay $43 for every $1 the company earned, with the stock trading at a PE ratio of 43.05. And things only got worse as they announced their Q2 earnings on December 20th of 2021. Their Nike Direct sales was now only growing by 9% year over year. And not only were their direct sales slowing down, they were also seeing sales slow across the globe, as Greater China sales fell 20% year over year. And this concern of where Nike's top line growth would come from continued in 2022, as they only grew their top line revenue by 5% in their third quarter, by -1% in their fourth quarter, and then 3.5% in their first quarter. In December of 2022, things appeared to be turning around. They reported their Q2 earnings and came through with revenue growth of 17% year over year, and Nike Direct sales grew by 16% year over year. And the company, who had struggled with inflated inventories over the previous year, believed that these issues were behind them. This had affected Nike's gross margin by about 3% over the course of the last year, dropping it from 45.9% down to 42.9%. This is due to markdowns that they had to incur to try and bring these inventory levels back into control. Ultimately, investors liked this earnings announcement and the reassurance that they were getting from the CEO, and they sent the stock up over 20% over the course of the next month. However, this growth did not last. Their top-line revenue over the last 4 quarters has grown by only 2%, 0.5%, 0.3%, and in the most recent quarter, their revenue was down almost 2% year over year. And on top of that, the once highlight of Nike's business, Nike Direct, is now seeing its revenue fall 8% year over year. And a company that investors were once willing to pay over $43 for every $1 of earnings, they're now only willing to pay $19.93 for every dollar of earnings. And the way that Nike gets back to higher valuations is by proving that they can grow their top line again. Prior to 2020, they were consistently growing their top line revenue by anywhere from mid-single digits digits to low double digits. And in my opinion, I think that Nike can get back there. It's just a matter of changing their strategy slightly to focus a little bit less on Nike Direct and keep growing their relationships with retailers. But keep in mind, don't buy a company just because I talked about it here on YouTube. Make sure you are doing your own research and looking into companies that meet your risk tolerance as well as your time horizon. With all of that said, I hope you enjoyed the video. If you did, drop a like down below, and if you want to see more videos like this one, make sure to subscribe. And as always guys, have a wonderful rest of your day. And for the joke of the day, why did the pony ask for a glass of water? Check the comments down below for the answer. Thanks for watching.